Hello everybody, welcome to the show. Today we're Wednesday, May 15. We have a special guest. We have Adam Gant, the largest unit holder of Partners Reit. If we take a look at Partners Reit right now, it's in a technical situation where, according to Mr. Gant, it's at the lowest price it will be, so it's a deal at this price. So we'll learn more about why Partners Reit is a deal at this price. So Mr. Gant, thanks for coming by.
Thank you for having me.
Excellent. So let's start. When you entered management, in the last interview you gave us, you said that your main goal was to lower the financing cost. Have you been able to succeed in that, even with the recent acquisitions that Partners Reit has made?
Yeah, and it's actually been quite surprising to see the actual cost of financing drop, even while I think most people would experience interest rates being fairly stable. The actual financing cost, the borrowing cost that we experience and that Partners Reit has experienced has been actually continued to reduce.
Okay.
In the most recent acquisitions, we saw interest rates of even below 3.4% our actual interest costs on our mortgages. And so I think there's been increased competitiveness amongst the banks for putting out new mortgage financing, and that's helped to actually reduce the borrowing costs for the REITs that are out there.
Excellent. One other thing that you mentioned in the last interview was about the deal making, because in the spring of 2012, there were a lot of REITs that actually raised a lot of capital, but you were saying that we don't see enough deal making in the retail centers. How do you see the deal making business right now going? Do you see that REITs are using their capital more?
Yeah, it's been interesting to see, actually. I think with cap rates having come down now, so there's been some compression, which of course is something that you'd expect as property values are rising. And I think a lot of that's been driven by a reduced cost of borrowing. In the spring of 2012, there was a tremendous amount of activity. All of the REITs were doing a lot of capital raising, a lot of acquisitions. There was a lot on the market, properties for sale, and that did stabilize somewhat through the summer and through the fall. We'd been working on a large portfolio. So Partners Reit closed on 2 of the properties last week or earlier this week that were announced for purchase earlier this year.
Okay.
So that actually took a fair amount of the REIT's time, and with those closings now, the REIT has really grown the overall portfolio.
Okay. And new acquisitions in Quebec, 2 new retail centers. What attracted you in them? What made them so attractive?
Well, we're always trying to get the highest quality properties that we can find that are accretive for Partners Reit. And certainly for us, what we want to see Partners Reit achieve over the long term is to continue to grow the portfolio of assets, the number of properties it holds, and to continue to diversify across the country. Around Montreal and Quebec has always been a spot that Partners Reit has held assets, and some of the most recent acquisitions included some brand new properties that were recently developed.
Okay.
And so those would be brand new in terms of building and age, as well as have fresh leases in place where you can expect a longer term to maturity, more predictable cash flows.
Okay.
So that's really what we're targeting, and that's what Partners Reit is going after.
Just to understand, right, so I mean, like when you have an old shopping center, it's harder to increase the cash flow. That's what you mean?
Yeah, well, what you find is if a property is much older, that means that typically your leases may have less time left on them,
Okay.
Which means that you could be facing higher costs to replace those tenants when you have to pay leasing fees and tenant improvement allowances and have to rebuild the building to fit the new tenants' requirements.
Okay, I understand.
So a newer building is going to have less maintenance requirements. It's going to have, usually if it's brand new, it'll have longer terms left on the leases, so there's less turnover.
Okay, I understand. What about, because I was looking over your portfolio, you're truly diversified in every province, but there's one in Quebec here, the Elgar Place, that actually caught my attention because the occupancy rate was about 76.7. First of all, why is that occupancy rate low as compared to the 90% that we see all over the other assets, and what actions has Partners Reit taken to correct that problem?
Yeah, absolutely. Well, this is actually a newer asset for us.
Okay.
And part of our strategy is to acquire properties that aren't fully leased. So you'll find if you look at our history, our occupancy would rise and then it would step back down, that would rise and step back down. What's actually happening is not the actual properties that we already own, but it's when we bring on new properties that aren't fully leased.
Okay.
Our goal is to fill them up and get additional income from that leased space. And so we typically can create more value that way. In some of the cases of the newest properties we purchased, there actually are tenants already in negotiation. The leases haven't closed yet, but we actually got income guarantees when we made those purchases.
Okay.
So we aren't exposed for that difference in income, but the lease doesn't show up yet because it's not a closed deal.
Okay.
So for us, wherever we can get some additional value by buying a center on its existing income when it's not completely full, usually means that as we fill it up, we add more income and value to the properties.
Okay, understand. Are you looking for other opportunities in Quebec?
Oh yeah, absolutely. I mean, we really have done well, and Montreal has been a great market for us. We just have our brand new Walmart opening soon at the Mega Center just out in Côte-Portue.
Okay.
So that's going to be great to see open up, and the center will look much better with the new facade and the other tenants coming in.
Okay.
With some of the newer assets we've acquired, we've got a very strong base here now, and hope to continue to build the portfolio in around Quebec and Montreal, especially.
Okay, but mostly Montreal, not Quebec City also?
Quebec as well. We haven't found the right property yet,
Okay.
but we've got a good hub here in and around Montreal with the management team in place and the capacity to look after a greater number of assets. So as the opportunities present themselves, it's always one step at a time. We'll continue to expand.
Okay. One key thing that I remember in the last interview you gave us is that you mentioned that a lot of quality assets in the retail business are actually held by few big players. So in order for Partners REIT to have an edge, it's to be before those big players get their hand in those quality assets, because when they get them, they won't let them go.
Yeah.
You mentioned that the key was to actually have some partnership with some developers. You already have some partnership with some developers in British Columbia. But what about Quebec? You mentioned that you were in negotiation to do some closing with some developers in Quebec and also in Ontario.
Yep.
How are the negotiations going on? Have the deals been closed? And
Yeah, absolutely. So certainly some of the assets that we've recently completed represent a new relationship for us in Montreal.
Okay.
And as well in BC, there's an additional relationship that is forming that will lead to further projects being built out. BC is interesting because of the terrain, the mountains and the rivers and the lakes, and BC also has something called the Agricultural Land Reserve, which has actually taken a lot of the farmland out of the land area that could be developed.
Okay.
And so because of that, generally speaking, BC is under retail. There's less shopping centers than there's actually demand for retailers to have stores. So there's a good amount of development that will happen in British Columbia, and we'd like to certainly end up owning a lot of those assets that are completed there. And are hoping to see that happen over time.
Okay. So if I understand right, there will be new developments in BC, but also in Quebec, also with those new developers, right? Is that correct?
Absolutely. And we're hoping to add further relationships in Ontario and Alberta as well, where we currently don't have as big of a portfolio as we'd like.
Okay. But isn't it like more expensive when you ask the developer to develop a new retail center? In terms, isn't it more capital intensive, knowing that you also have to keep a certain distribution rate as a REIT?
Yeah, well, certainly partners won't be engaged in significant development activity.
Okay.
Partners will acquire an asset that already has an income stream and add to it.
Okay.
Partners isn't building from the ground up new centers, and that's why those relationships are important. Is if there are development groups out there who are building brand new shopping centers that partners would like to own, then it is important that partners has a chance to buy them without having to get into an auction process or seeing the prices get bid up. And only own them once there is income in place.
Okay. Now there's something interesting that happened. I was looking at your recent news release, and there's a proxy fight. Surrounding Partners REIT because the chairman seems to not be happy with the management team. You, as the largest unit shareholder, how do you see it?
Well, so I think from our standpoint, we've been considering the future of Partners REIT, and what you may have noticed over the last 3 to 6 months is we've brought on Partners REIT has added a number of very significant executives to the team. Most recently was the Chief Investment Officer, who's Ed Boomer. And Ed is somebody that's well known in the real estate world in Canada, but somebody who has built up a portfolio of retail shopping centers in Canada of over a multi-billion-dollar portfolio. So he actually helped to grow Kimco from $500 million up to over $3 billion of retail shopping center investments in Canada. Peter Morris, somebody that was that joined the management team back in the fall, has run multi-billion-dollar shopping center portfolios in North America. Patrick Minuti, who's the CEO of Partners REIT, has run previously multi-billion-dollar retail shopping center REITs. And so we've been looking at the trustee group that we have today, and not a single one of them has ever run a multi-billion-dollar retail shopping center portfolio. And so that was something that if we wanted to see Partners REIT become a multi-billion-dollar retail shopping center REIT, we thought was very important to have as part of the advisory group. And so we wanted to bring in some additional trustees. And so we didn't ultimately decide to support, or weren't planning on supporting, some of the existing trustees for the AGM that's coming up, and wanted to bring in some new trustees. And what has now come up is the existing trustees trying to entrench themselves and to stay there and not to see any change happen. Okay. So for us, I mean, we're very committed. We want to see Partners REIT become another Canadian success story. It's grown a long ways. It's come a long ways from when we took it over and built it up, and we're very committed to seeing it become a multi-billion-dollar shopping center REIT. And some of these changes along the way are necessary, or the new people that we're bringing in are certainly something we see as valuable for helping the REIT to get to that next level.
Okay. And what about this process here? So you actually committed to actually move this process forward, to bring the new management team, people with a lot of credible experience. So are there like some deadlines that we have to look over, for instance, to be able to see, is Mr. Gant is going to be successful to bring his team, to bring the changes that he wants in the Partners REIT?
Well, certainly for us as the largest unitholder, we want to see the management team that's built the REIT, that's had the success it's had, continue to grow the REIT, and we want to see the new trustees come in. We want to continue to make sure that the unitholders understand what's going on and know that they're supporting the growth going forward, and want to see the new trustees come in. So there's been a gold circular that's recently been mailed out to everybody, so they should definitely vote the gold circular and support the new trustees. Okay. And your comment earlier, to me, this seems like a classic kind of Warren Buffett moment where you have good management team in place with a track record, and you've got this temporary event that's happening that's caused the price to become very attractive, and now between good value compared to the net asset value, as well as a very attractive yield. And the other thing, and this is something that we really like about Partners REIT, is it's still got lots of depreciation allowance left. So all of the distributions paid out last year were fully covered, and were all tax efficient or considered return of capital. So the yield is very attractive. It's tax efficient. The value is great, and I think Partners REIT is in a good position now with the team in place to build going forward.
Excellent. With this depreciation that you mentioned, because you mentioned that it was because your guys are a new REIT that you're able to actually have this depreciation and higher return on capital for investors. But when are you going to actually reach the point where you're not going to be able to have that?
Yeah, that's a great question. So it's funny because it's probably one of the key factors that makes new REITs attractive compared to existing or incumbent REITs that are out there. Because they have recently acquired their assets, they have full capital cost allowance pools. So what happens is, if over time the REIT continues to grow and acquire new properties, that ability to appreciate gets replenished. So it's at a point in time in the future where the REIT has stopped acquiring new assets, or the rate of growth slows, and a number of years pass where the depreciation is taken and those pools dry up. Okay. But that's still what we see is many years down the road for us.
Okay. Yeah. So let's talk about now the perspective, because let's say that your fight is successful. You're able to bring the new team back as the largest unit holder of Partners REIT. Where do you see Partners REIT in the next 5 years? What's your vision?
That's good. I certainly am passionate about it. I really feel very proud of what the team has done, and the management team that's there to date. They continue to improve their capacity to run a larger portfolio, to add additional tenants to the REIT. I'd like to see the REIT continue to create the kind of value that it has over the last 2.5 years for the unit holders. Continue to grow the asset base, continue to improve the quality of the assets as it's acquiring newer assets. And I could definitely see it in the next 5 years breaking through that $2 billion asset level mark. Okay. And the team is just driven. They continue to work at growing and building it, and just seeing that steady growth going forward. Okay.
One last question is, you mentioned also you wanted to diversify a little bit your portfolio, but from what I've seen, it's mostly retail assets that you retail shopping centers that you have as assets in the portfolio. Yeah. What did you mean by diversifying? Is it across provinces or?
Yeah, so more the the geographical location,
Okay.
diversifying over the rest of the provinces that we don't have a lot of assets in currently. Some of the largest REITs are diversified REITs. One of the largest REITs, certainly most people would be aware of, is a pure play retail shopping center REIT. And we do plan to be a pure play retail shopping center
Okay.
REIT
Okay.
and focus on retail shopping centers. So the goal is really to diversify the number and the geography in which we hold shopping centers across the country.
Okay. One last question here, Mr. Gant, because to finish this interview. So what can the viewer, someone who's looking at Partners REIT and ever since the first interview has not yet bought some shares of Partners REIT, what would you tell them to say, hey guy, at this price you should definitely get in?
Yeah.
2 reasons.
Well, certainly the value is below the NAV, and I
Okay.
think that's always a good indicator of when it's a good time to become a unit holder. And the yield is extremely attractive right now. At the price it's trading at today, it's a great yield, and we've grown the base of the properties. The REIT's got good liquidity, and it's poised for further growth with the team that's in place.
Okay, excellent. So look forward to for you to come by, and hope that you're successful in your proxy fight.
Yeah. Well, thank you, and thank you for having me.
Thank you, Mr.
Okay.
Gant.